Good day traders, this is the daily market update live from the Tradelo trading floor. It's Thursday the 16th of May. Some highlights from today's show. Stock markets are primed to soar. Dollar is signaling a top and BTC is ready to rally. Let's start off and talk a little bit about some of the key overnight news. Well, the US Bureau of Labor Statistics said that they accidentally published the CPI data 30 minutes ahead of schedule yesterday. Also in news overnight, well, the Bureau of Labor Statistics reported that inflation only rose 0.3% from the previous month. This was a little bit lower than expected, 0.1 lower, but it was also the slowest pace of this year. At the same time, a separate report showed that the control group retail sales used in calculating GDP slipped 0.3 in April. And this is just another sign that the US economy is experiencing some healthy cooling. Now, let's get stuck into today and talk a little bit about the S&P 500 because it is set to soar and continue rallying into record territory. The reality is the market reaction from the CPI really does give us a significant clue. Why? Well, look, going into yesterday, there was some concern that we were going to see yet another uptick in inflation. The result is not only did it come in line, but it actually had a little bit of a miss. And this created a collective sigh of relief. Now note, over the last couple of months, we've heard the Fed tell us that they believe the recent uptick in inflation is nothing more than seasonal. Moreover, they've told us that they think shelter inflation, the one thing that's keeping inflation elevated, they expect base effects later on this year to fall out, and that should then bring inflation back towards that disinflationary trend that we saw for most of last year. Now note, the Fed has told us that they just need a little bit more confidence before they can bring cuts into view. Does yesterday's data print add to this confidence? Of course it does. More importantly, don't forget, Mr. Powell has stressed patience. He's told us, look, they're not going to hike again, but they are going to keep rates higher for longer and as high as they need it to be because it is restrictive and it's doing its work. However, the moment they see just a little bit more confidence, they are ready to begin the process of cutting rates. So does yesterday do anything with regards to rate cut expectations? Well, a little bit. If we look at the implied expectations of rate cuts, right now there's a 1 in 4 chance of a rate cut in July. It's still relatively small. However, keep in mind, between now and the next FOMC meeting, we've got 2 non-farm payroll prints. We've got 2 CPI prints, which means with the July meeting being the next likely or the likely meeting, they could begin the cutting process. We've got 2 more key data points from both NFP and CPI, which very much makes July a prime date to begin the cutting process. And this is music to the equity market's ear. Why? Well, we need to look a little bit of context. Go back to the start of this year. What did we have? Well, we had the markets, looking at the 2-year, rally from around 4.3% all the way up to 5.05%. Now, this move in yields was a significant tightening for the markets. As a result, we saw the 6% correction in the S&P 500. Fast forward, we topped out at 505 in the US 2-year at the end of April. We now back down to 474. That's 30 basis points of loosening. The loosening of these financial conditions is what has created this rally back up to record high. If the markets are now intent on pricing in the start of a rate cut cycle as soon as July, we can expect to see this rally not only extend, but begin to accelerate. With that in mind, traders, it's very important. When we go into price discovery mode, there is absolutely no point sitting there fading it. Why? Because there are no technical levels. It's clear blue skies. Factor in as well, VIX is now trading at 1285, which is the lowest it's been in a year. The conditions are ripe for a continued rally. Now, with yields likely have topped for 2024, what this means is that the Russell, which has been the massive lagger of the year, now that should start to outperform as yields start to fall away. What that means is that the rally is no longer going to be tech driven. It's now going to be broad-based driven, with tech likely lagging the broader indexes. So keep a very close eye. If that Russell starts to rally, it really is just going to add some ammunition and some fuel to the rally for equities. Now, let's take a look at the dollar. The dollar seemingly has topped for this year and possibly topped for this cycle. What we need to do is we need to actually take a little bit of a step back, have a look at the chart, and just go back to the beginning of May/end of April, because that's when the dollar topped out. Now, what created this topping process in the dollar? Well, it was a combination of weak data. We had weak jobs data in terms of the non-farms. We had weak retail sales coming out. We also had the slump in services PMI. It was the culmination of really weak economic data that's creating this idea of a cooling effect in the US economy. Now, what that means is that, yes, the market thinks the Fed is likely to begin the process of cutting rates later than perhaps the ECB and the BOE. And that's primarily why we saw such a strong rally from the dollar, which started in March. However, with all that cooling in the US data, what we did see was the dollar topped out already at the end of April. Now, factor in, the ECB's told us they're going in June. The BOE is signaling that they're also going to go shortly after. The SNB's already begun the process, and the BOJ doesn't seem to have ever begun the process of hiking rates. The reality is that the dollar topped out long before ultimately the other central banks begun the process of cutting ahead of the Fed. Now, what that means ultimately is, should we see the Fed bring forward that rate cut and begin the process as soon as July, the market positioning is still quite long dollar, which means we do have quite significant downside potential in the dollar over particularly the near term coming weeks. Keep a very close eye. If the data continues to weaken, that will add some significant sell pressure to the dollar. Moreover, as we start to see the implied odds of a rate cut from the Fed increase for July, that will just add fuel to the downside for the dollar. Don't forget, the dollar is still marginally higher against most of the G7 currencies this year. So keep a very close eye, because dollar seems to have topped already for this cycle. Now, let's take a look at BTC, because it is absolutely ready to rally. If you've been following this channel, you will know that the key driver of Bitcoin is very much the tech stocks and just risk sentiment in general. Now, coupled with that, a weak dollar environment, we really have got a market that is primed for a rally back up to initially 72,000 resistance, and thereafter a break of record highs and a rally up towards that 100,000 mark. So keep a very, very close eye. Like I said, if the dollar has topped for this cycle and we're about to see a significant rally in tech stocks, it's going to take BTC up with it. So it's very much green light for a rally to 72,000 in the near term, which is roughly 10% from current prices, but thereafter a rally up to record highs and beyond. Don't forget, over the last couple of sessions, unfortunately, the likes of AMC and GME has stolen quite a bit of the shine from Bitcoin. The reality is AMC and GME, that whole saga is now over. It was kind of a one and done, which means those flows that typically went to the AMC and GME should now move back in towards the Bitcoin and the cryptocurrencies in general. So crypto is very much green to go over the next couple of sessions, particularly if that dollar does continue to weaken and the equities continue to rally. From an eco data standpoint today, it's very light. We've simply got the initial jobless. Now note, however, this is one to pay attention to, because last week we had quite a significant beat on the initial jobless. Now, in normal times, initial jobless is not something you would keep a close eye on, but these are not normal times, and we are seeing significant slowing from the US economy. Like I said to you, right now, a slowing US economy means that the likelihood of July comes into view from the Fed. Moreover, like I said, it's also the thing that's driving the dollar lower at the moment. So keep an eye on initial jobless. The previous week we had quite a big uptick. Don't forget, 217,000 is the highest it's been in the last 8 months. Today it's expected to come out at 220K. Above that, and we are starting to see the highest number in over a year. Now again, whilst that's not high relatively speaking compared to the last couple of years, it is that kind of an economic data print that is very forward-looking. It's very, very important for the labor market. So keep a close eye. If we do start to see a continued deterioration, you're going to see a lot of investors start to bet not just on a slowdown in the US economy, but also the beginning of a rate cut cycle as soon as July. That's it then for today. Good luck. Go manage your risk. Make some money.